everyone, welcome to Chart Attack. And today we're going to be looking at the equity markets. And if you recall, about 2 weeks ago, I did a video series and an article about the US markets and how they established their bear market lows. We were actually looking at this range, which was developing, where the markets were holding this range since June. We got that breakout on July 19th. I believe the article came out on July 20th. So it was the breakout which we were looking for, and our readers have done well with that trade because the markets have indeed moved up after retesting that breakout zone. However, in the article, I mentioned a couple of levels that I would be watching, major weekly levels, which I'm calling resistance levels, and we are there right now, folks. So these major weekly levels on the S&P 500, on the NASDAQ, on the Dow Jones are the only things which are preventing me from turning into basically a full-on perma bull. And let's actually go down to the weekly charts, or move up actually to the weekly charts, so you understand why these levels are very important. They're really important because way back in April of this year, these were the weekly levels or weekly support levels which broke on all the markets, basically initiating or confirming this new downtrend. And you can see here, we move lower and lower, and now we are actually back to retest that major weekly zone. 4,200 or 420 on the S&P 500 is what I'm watching. And funnily enough, as we move up to test this weekly resistance level, we did begin to see some sell-off actually, late last week on Friday and on Thursday. And you see the same thing with the NASDAQ as well. Look where the NASDAQ is, exactly at our major weekly resistance level. Also note my moving average for those of you who know or who employ moving averages in their trading. They tend to be an area where we see sell-offs like we did back in March and April of this year. And then also with the Dow Jones, right? Very similar. The chart is maybe a bit more dirtier, but that's the major weekly resistance level that we've been watching. So keep an eye out on that weekly level, because if we do not close above these weekly levels by the end of this week, or by the end of Fridays for weeks heading forward, there is a chance that the markets continue to move lower, because technically the downtrend is still intact if you do not close above these major weekly levels. So what could cause these markets to sell off even more? Well, besides the geopolitics, which we'll talk about in just a second, I've been keeping an eye out on the bond markets, and I think many people have as well. There was a major breakout on the bond markets, and if we go to the TLT, or the 10-year yield, there was this breakdown below 2.70%. A lot of people thought this was a head and shoulder. Well, technically it is a head and shoulder pattern. And a lot of people were saying that this is now the market pricing in the end, or close to the end, of Federal Reserve rate hikes. Because of a recession, the Fed will have to start cutting interest rates. So in a way, the market's like already pricing in QE, even though the Fed has not said that, we're going to be turning dovish right down the road. Some people are saying, because of their more pragmatic approach now, that's a sign that they're turning dovish. But, the Fed has not said that exactly. And again, the Fed hasn't even acknowledged a recession, even though we've had two subsequent quarterly declines, which meets the definition. So right now, the market is technically pricing that in. Why? Because if rates are going to go down, bonds that are yielding this percentage right now are going to be worth more than bonds that are going to be issued later on when the Federal Reserve starts to cut interest rates. So it's best to buy the bonds that are yielding this percentage level, because we might not get that for the next few years if the Federal Reserve begins to cut interest rates, right? So it looks like that's what the market's pricing in. There is another case as well and that is perhaps, traders are buying bonds because they believe that there's this fear, right? Usually money runs to bonds for safety. Although we're not really seeing that right now as I'm speaking, although I just think that this is because we're basically seeing relief pullbacks in this new trend here, which I'm watching on bonds and the TLT. And I would also argue if this was a fear move, you would want to see bonds and the US dollar move up at the same time, just indicating this run into fear as people sell stocks and run into bonds and the US dollar. So that's one, reason where the markets might have it wrong, right? The markets are maybe already beginning to price in a return to QE and cheap money, but the Fed has not said that just yet. However, investors are pricing that in, and there could be this rude awakening come September when the Fed's like, hey, the labor market's still strong. We're not in a recession. We're going to continue to raise rates to tame that inflation. And the market's going to be like, oh, we thought that because of recession, you guys might just hike a bit more, but let's see how hawkish the Fed becomes, right? The next thing, of course, is, geopolitics, right? We've heard Nancy Pelosi's in Taiwan, first high U.S. official to visit the country in 25 years. And, China's threatening, well, they have threatened military action, probably not going to do that, but you never know what the Chinese are going to do. They're probably going to have some sort of reaction. And I think that just adds more, not necessarily fear, but just this uncertainty in the world as well, right? Which is usually not very positive for the stock market. So keep that in mind. And I find it's very interesting that this is all happening like on the geopolitical side of things, especially as we are testing our major resistance levels. And for those of you who have traded markets or follow technical analysis, this just tends to happen, where you look at the charts and then all of a sudden you see the news come out, and it goes to that old saying, right? Show me the chart and I'll tell you the news. But I find that interesting that all this is happening, exactly when, we're sort of at this major resistance levels and could provide, some catalyst for that rejection. So what I'm trying to say is, that was a great trade, right? We said that move on the equity markets after that breakout was great for trading. However, we weren't turning full perma bull because there's still those major weekly levels that we have to watch for. So I guess I don't want to be that guy that sounds pessimistic, but I just want to let the bulls know that, hold your horses, right? We might not be there just yet. There's still this one level that we need to take out, but once that is taken out, we can turn perma bulls right now. So keep an eye out on that US dollar chart, keep an eye out on the bond market chart, and more importantly, keep an eye out on these equity indices, especially on the weekly charts, to see if we can get a break above our major resistance levels. But that's it for me, folks. If you have any other questions or you have any comments about the markets, please let me know in the comments below. And let me know if you guys think that this is the bottom of the markets or if we are going to continue this bear market going forward. I really would like to hear from you guys. But other than that, happy trading, folks.